Hello, and welcome to the webinar, 10 Mistakes to Avoid This Year End. My name is Eric Wallace with Argyle, and it's great to have everyone joining us today. I have a few administrative details to share with you, then we'll dig into our discussion. First, we would like to thank Experian for their partnership with today's event. They've been wonderful thought leadership partners to Argyle, and they're committed to providing you with valuable content and a great overall experience. Thank you again to Experian. We appreciate you joining us today. We welcome you to stay connected during today's event. For those of you who are active tweeters, please follow us on Twitter at Argyle Exec Forum. I also wanted to take a moment to touch on our content neutrality policy, which we've curated based on the feedback we've received over the years from our members. Argyle is very proud and protective of this policy, as it reflects our commitment to ensure the neutrality and overall value of the content presented at our events. We've worked closely with our speaking faculty to ensure that you receive a set of balanced and neutral viewpoints during the session today, and we appreciate our members' support of this policy. For those of you who are seeking CPE credit, you must answer at least 3 polling questions and remain on the session for its duration. Polls can be found under the Polls tab on the right-hand side of your console, right next to Chat. Afterwards, if you're eligible to receive credit, you will receive an email with a link to your certificates. If you have any questions about credits, please email cpe@argyleforum.com. Finally, and most importantly, please submit all questions that come up during today's event into the chat section of the interface. Before we start, I'd like to have our speakers introduce themselves, and then we'll begin our discussion. John, over to you. Can you please start?
Hi, welcome to our webinar attendees today, and thanks for joining us for our 10 Mistakes to Avoid This Year-End Season webinar. My name is John Hay. I'm a Vice President of Marketing at Experian Employer Services, and I'll be serving as our moderator today. Wayne, do you want to introduce yourself?
Sure. Hi, my name is Wayne Retcher, and I am Vice President of UI Tax here at Experian Employer Services, and looking forward to sharing some information with you about unemployment today.
I'll jump in. My name is Michael Orton. I am VP of Payroll Tax here. So we'll be discussing a few hot payroll tax items. Happy to be here.
And hi, I'm Janet Andrews. I'm the manager of ACA Client Success here at Experian Employer Services. And I look forward to sharing some information about ACA and year-end reporting.
Thanks, guys. So like I said, I'd like to thank everybody for joining us for our webinar today. With the temperatures cooling and the fall leaves in full splendor, it's a good indication that the year-end season is right around the corner. As the busiest time of the year for HR, finance, and payroll leaders, not only do you need to prepare for your usual year-end activities, you also need to navigate some pandemic-era policies. Today, we're here to discuss some of the steps you can take to help make it a smooth year-end season for you and your organizations. We did introduce ourselves, but I'd like to give a little bit more background information on our various speakers. Wayne has over 35 years of experience in unemployment compensation consulting through various positions in close collaboration with government agencies. He pushes himself and his team to provide the highest levels of customer service while also maintaining the highest savings possible for a client. As an ACA support manager, Janet Andrews helps HR professionals with the ever-changing ACA filing requirements. She has more than 7 years of experience in ACA fulfillment, including the production of over 10 million ACA forms for tax year 2021. In her role, Janet focuses on customer service and exceeding expectations in every interaction. Michael Orton joined Experian Employer Services in 2021 to lead the payroll tax consulting practice. He has extensive experience in M&A compliance, payroll tax refund recovery, federal and state payroll tax audit support, and tax penalty abatement, and finally, COVID-19 payroll tax credits, which we'll be talking about today. Over the past 10 years, Michael has helped hundreds of clients work through complicated payroll tax issues, improve payroll tax processes, and recover over $500 million of federal and state payroll tax refunds and credits. Here's a quick look at our agenda. We're going to cover a lot of ground today, including unemployment tax credits, payroll tax planning, employee retention credits, and regular year-end ACA and tax compliance. To help you with your planning efforts for this year-end season, we've organized our discussion today around the 10 mistakes we're going to help you avoid this year-end season. But before we begin, we'd like to get a better understanding of where we're starting as a group with our year-end planning. So we'd like to ask our first poll question. The question is, how comfortable are you with year-end compliance requirements following COVID-era cultural shifts in the labor force and regulatory requirements? A, very comfortable. B, somewhat comfortable. C, not at all comfortable. We'll give everybody a couple seconds to respond. So it seems like we're getting a good level of responses now. Wayne, it's interesting that, and probably not surprising that I think the audience overall feels somewhat comfortable.
Right.
Almost 2/3 of the audience saying they're somewhat comfortable. So it's good that people tuned in to the webinar today so that we can help them out with making sure that they've got everything they need for this year-end season.
Right. So maybe by the end of the poll, we can retake this question at the end of the session, and we'll see a lot more very comfortables up there, right?
Yeah, let's hope so. I'll turn it over to you now so that we can get a better understanding of an employment tax. It's been a hot topic for many employers since the pandemic, and looking forward to you walking us through the first couple of mistakes that we should look to avoid.
All right, John, thanks very much. Right. So the first thing, I know if you've been, listening to the media, if you've just talked amongst yourselves and APA or whatever, you've surely been asked or wondering what is going on with these FUTA tax credits this year, and are we going to see any? That's really been a lot of questions that we've had to answer here. So for those of you who aren't familiar with what this is, when the state's trust funds get depleted, like they did obviously as a result of COVID, they are able to request an account balance for going forward to put into their account balance their overall trust fund. However, being a loan, it must be repaid. So if that's not repaid by a certain time, then they'll accrue interest on that. So for example, here, if they don't pay the interest by September 30th, they'll get interest. And if they don't repay that loan by November 10th of the second January 1, then that's when you'll see the FUTA credit reductions showing up. So right now, actually, we've been monitoring this all summer because, again, we've had a lot of questions from customers. And right now, there are 5 states and then 1 territory, Virgin Islands, that have an outstanding advance balance. New Jersey is 1 state that has an authorization, but they haven't actually made a loan on that yet. So California is sitting almost at 19 billion in a loan. So we don't anticipate that they're going to get theirs paid off. So there will be FUTA credit reductions. The other states, Colorado, Connecticut, Illinois, New York, those at this point, based on the intel that we have, those will all be FUTA credit reduction states on the 2022 form that you'll be filing, the 940. So just be on the lookout for that, because if you haven't anticipated that in whatever forecasting you've done for the upcoming year, then you're going to get a surprise come 1/31 when this comes due. So just that's item number 1 here. It's pretty important, and this probably is an item that's been more on people's minds than not. So I feel pretty good based on the customers that we've spoken with that a lot of them are ready for this. They've already budgeted for it and let their finance teams know. The next unemployment tax faux pas really is to make sure that you are taking advantage of all of the tax rate decrease options. Not every state offers these options, but what it does is it allows you to, the VC on one hand, allows you to make a prepayment to lower your overall rate for the upcoming year. So this is allowed in 27 states. And it's a calculation that you as an employer have to do. The states don't, create that for you and tell you what your options are, because they obviously don't want you to save any money. They want as much into their trust funds as possible. So you'll want to know what states those are. You'll want to know what the deadlines are, because there are deadlines for filing those and making those payments. And then you'll want to know how to calculate that. So, and it's simply changing the ratio between your account balance and your taxable payroll in the given state to then apply it to your table, and it'll lower your rate. So there's definitely some finesse that has to be done with regards to that. So make sure that whomever is doing it understands the calculation. For joint accounts or common rates, there are fewer states than allow voluntary contributions, but there are some states that will allow employers, and usually you have to have common ownership, management, or control. You will be allowed to combine the tax rate experience, not a legal merger by any means, but you combine the rate from company A with company B, and then together, if that lowers your overall tax, then that's good for you. And you can put 2 accounts into a joint account. You can put 10 accounts, no matter how many you've got in a given state. And there are some states that will allow you to set up more than one joint account if you happen to have 10, 15, or 20 federal IDs. And it makes sense to put these 5 together and these 3 together, and so on and so forth. So that's allowed in 7 states. This one's a little more risky, however, because some of the states will let you in and out of this in 1 year. So you're stuck with this, or hopefully have a good option there for the coming year. However, there are a couple of states that make you stay in that joint account for 2-3 years. And so you may not necessarily know what's going to happen to your business in 3 years. You might have a pretty good idea, but you're not 100% sure. And you certainly won't know what the factors that the state has control over might change. So taxable payroll, or taxable wage base rather, tax rate schedules, surcharges, that sort of thing. So while we will, as an organization, we will notify our customers what their options are there, but it's all has to be done within a time frame. It all has to be done within the statute. And we're not always going to make recommendations on those 2 and 3 year unless you have a pretty good feel for what's going to happen with your business over the next couple of years, or whatever the length of that joint account is. Okay.
Thanks, Wayne. So we're back with our next poll question. Wayne, I'd love to get your thoughts on kind of how you think the audience is going to respond to this. Our question is, how active are you in pursuing voluntary contribution or joint account activities? A is significantly, B somewhat, C not at all, or D, I don't know what this is.
Right. Well, it's funny, and unless you're really in the trenches on this sort of an issue with the various state rates, you probably don't know, or it hasn't really been brought to your attention if you don't use a third party or something like that. So I can't say that I'm super shocked by that. But I guess what I can say is, now that you do know, I would suggest that you take a look at the state websites, find out which ones allow a VC, and certainly take advantage of that, especially in states where you have a high payroll.
Yeah, and it does look like there's some opportunity here. About 40% are saying not at all, 36% saying somewhat. So it certainly looks like an opportunity that some organizations can take advantage of.
Absolutely.
Right. I'd now like to welcome back Michael to discuss some potential tax rate changes and payroll tax reporting errors.
Actually, this one's still mine.
That's
John.
yours as well. Sorry, Wayne.
Michael, unless you want to take it on,
steal the stage from
are
you.
welcome.
Sorry about that, Wayne.
Okay. Hey, no problem. No problem. I wondered why that poll shot up when it did. All right. So the next thing from an unemployment standpoint is you want to make sure that you are forecasting your rates for the upcoming year. I know we've heard sometimes with different companies that we've been associated with, you know what, I just use last year's rate. And that's not a good plan, especially with how COVID has changed the landscape and decimated these account balances throughout the states. So in order to replenish those, fortunately, a lot of states used ARPA and CARES Act money, but not all of them did. So then that falls squarely on the employer to put more tax in than what they were already planning on. So as you probably know, if you've seen anything in the media, the current total unemployment rate, at least for the last period that I was able to see, was 3.7%. So compare that to the average for 2021, where it was 5.3%. This looks good, right? It's trending downward. But for the remainder of this year and next, the economists are saying this is probably going to be increasing, and that's due to that bad R word that we've all been hearing about here lately. So forecasting rates is not necessarily a simple thing. So similar to what I was talking about with the voluntary contributions, you have to know how to calculate that. You have to know what the state, what the factors are that the states use. But if you do that and estimate certain factors like payroll, if you're not 100% sure where your payroll was for a certain quarter, this is going to give you a much more accurate reflection of what your rate's going to be for the upcoming year, as opposed to just using whatever last year's rate was. So for example, in this year, we talked a little bit about how there are state factors that are impacted by for rates. This will tell you here that we are anticipating that there are going to be about 8 states that will have some sort of an increase in 2023. That's based on our research, as well as historically what we've seen, especially during recessions. So that could be a tax rate table increases, or there might be some additional surcharge added to your rate, or maybe a taxable wage base increase. So all of these things are uncontrollable, right? You don't have any control over them. So if you do a better job of anticipating what your part of the rate is, then it's going to be more accurate. 4 states, believe it or not, are planning on, or we believe are going to be decreasing their rates in some fashion. And again, that'll probably be through table decreases or taxable wage base decreases. And you can see on each one of those lines, I've named the states that we're anticipating these increases or decreases taking part in. So, okay, so I will now turn it over to Michael, and he will be talking to you further. Michael?
Sorry, it took me a while to come back on camera. Hey, everyone. So the first topic I want to address is don't miss the last Social Security deferral repayment. So I want to take you back to 2020. One of the first things Congress did was they instituted this Social Security deferral, where they allowed employers to defer their portion of Social Security tax liability. And back then, the deal was you can defer it in 2020, but you have to pay back 50% of that deferral in 2021, and the remaining 50% in 2022. Well, here we are, the 2021 deferral repayment should have already been made, and we're now facing the final deferral repayment. And the reason this is so important is that the statute says that any repayment that is made by the due date will be deemed timely. And the fear is if you don't repay that amount timely or in full timely, they could apply penalties all the way back to 2020. So you can imagine what a significant cost that could result in if you don't pay back the full amount, or if you don't pay it back by the required date. So it's really, really important that you guys are fully aware of this repayment that's upcoming, that you investigate how much remains, how much is still owed, and that you repay the full amount by the due date. Now here, the final 50% is due by January 3rd, 2022. In statute, it was due by December 31st, 2020. It's due by January 3rd, 2023, the final repayment. It was due by December 31st. However, because of the weekend rule, it falls on a weekend, and so you get a few extra days to repay that amount. So my suggestion here is talk to your payroll tax teams, talk to your payroll tax advisors, make sure that you are prepared to pay the full amount on a timely basis. The next piece I want to discuss is, I know this is a hot topic. It's all about the payroll tax reporting errors related to remote work or hybrid work. The reality here is when you have a remote worker or a hybrid worker, there's a greater chance that that employee will perform services in more than one state throughout the year. And anytime you have someone working in more than one state, it creates some complexity on the income tax withholding side, right? So for example, when that happens, you have to be able to accurately track your employees' whereabouts. You have to be aware of potential reciprocity agreements between the states that would source all income tax withholding to the resident state. You have to be aware of the de minimis thresholds that might be in place in those states that will state a non-resident is not subject to withholding until they've spent more than X number of days in my state. You have to be aware of your payroll system limitations, right? Unfortunately, when you go about making these changes, not all payroll systems have the capacity or capability to make these changes easily or in real time. So often when you're faced with these challenges, you're required to go back and make retroactive adjustments. And for any person who's done that in the past, it isn't something that can be done quickly or easily. So you need to prepare yourself. And lastly, there are some specific W-2 requirements to be aware of. It's not an easy situation. I don't know any employer that shoots for 100% compliance. Truth is, 100% compliance is nearly impossible in this realm. However, it's very, very important to be aware of the issues and to be moving towards compliance and trying to do your best, right? One thing that's worth mentioning is that most payroll systems have a very basic assumption. They make a very basic assumption, and that is income tax withholding should always be sourced to the work state. As you know, payroll systems ask for two addresses. One is the residency state, the other is the work state. And they assume that all services are performed in the work state. We all know that isn't true during this COVID. It's definitely not true during COVID. It wasn't true during COVID, and it definitely still isn't true today. And so it's important that people look at that basic assumption in their payroll system and make sure that things are set up properly. The last thing to be aware of, there's a lot of talk as of late about the convenience of the employer rule. New York is the famous state that simply says, if you are assigned to a New York office and you choose for your convenience, but not the convenience of your employer, to work out of state, New York still imposes income tax withholding on all wages paid, even if the service is performed out of state. There are 5 or 6 states now that have a convenience rule in some form or fashion. So it's important to be aware of those rules and try to stay on top of those rules. I have a poll question here. John, you want to take over?
Yep. Thanks, Michael. So coming back with our next poll question, I'm really interested to kind of hear or see what the results are on this one. To what extent has the remote worker culture affected your year-end tax planning? And I think I saw a recent Gallup poll said that over 50% of employees expect to be working remotely going forward. So, Michael, what you just covered, I don't think is probably going to slow down anytime soon in terms of kind of having to manage.
Yeah, the challenge, I totally agree. Remote hybrid work is here to stay. And the challenge is there is no hard and fast rules that you can rely on in all cases, right? Unfortunately, it does become a case-by-case analysis where you're looking at each specific scenario and deciding what is best to do.
Mm-hmm. Yeah, and it looks like our answers are coming in. About a fifth of the audience said it has significantly impacted, but then 30% said not at all. So interesting mix of results. I'll turn it back over to you, Michael.
Thank you. This is a big one too. Unfortunately, we should all expect delays when amending the Form 941X, and really most amendments right now. I have many clients who are awaiting a refund or an amendment to be processed, and they've been waiting for more than a year in some cases. And truly, when we talk about that, there are 3 reasons that those amendments are taking longer than they should or longer than they typically do. First, There are many, many common reporting errors. I spend much of my day reviewing 941Xs that have been submitted by clients. And unfortunately, and this closely aligns with the ERC tax credit. There were changes made to the Form 941 in 2020 and in 2021 that I would say significantly complicated. It complicated the form itself. And with those complications, we see clients making errors when completing the form themselves, and we even see third-party vendors making errors when they complete and submit the form. So I would say right now the error rate where we find errors is probably somewhere between 5 and 15%. So I tell people all the time, if you've been waiting a while for for an adjustment to be processed or to receive an ERC claim or even an FFCRA claim, you should look back at that 941X to make sure that there was no error on the face of that form. Because if there is an error, they will often deny the form outright and you're here waiting for nothing. Second, we are experiencing tremendous third-party payroll vendor delays. So oftentimes when you complete an ERC study, when it comes time to actually file the 941, you hand your information over to your payroll provider and ask that they submit the 941X on your behalf. Well, unfortunately, what we have learned over the past 2 years is that the amendment process for most of those vendors is very much manual. So they don't just punch it into a computer and press go and it automatically submits that on your behalf. Oftentimes, an individual is actually having to manually adjust that form. And with that type of manual adjustment at the third-party processor level, they are experiencing significant delays on their end as well. So be aware of that. If you are needing to amend or if you have amendment, I think you should be prepared for those types of third-party delays. And lastly, obviously, we are experiencing unprecedented IRS delays as well. So just as the vendor process is manual, unfortunately, the IRS 941X amendment process is manual as well. There are IRS agents opening every amendment that comes in, hand keying it in for review and processing. So we are seeing processing delays of somewhere between 2 months, and I would even say in the extreme cases to 14 months at this point. Okay, so even if your 941X amendment has nothing to do with the ERC or COVID credits, you could still get caught up in this amendment delay. And so the overall message here is, number one, make sure that you didn't make any errors on your 941 if you're standing in the waiting line. And number two, expect delays. There's little you can do to avoid it. Moving to the last one. This is prepare for IRS employee retention credit audits. There's been a lot of talk about this as of late. I think it is fair to say at this point that the ERC is probably the largest and most popular tax credit program ever. There are tens of thousands of employers out making these claims, filing their amendments. I think the participation levels are probably higher than anyone anticipated. And so with that, the IRS is trying, they're obviously mounting a defense and trying to decide how best to audit these claims. There was two interesting things that happened as of late. Number one, the IRS inspector, they issued a report, it's called the General Report, where they stated that as of March 10th, 2022, the IRS had already identified 11,000 returns that were fraudulent with more than $2 trillion in credits claimed. So they have already identified $2 trillion of fraud with regards to ERC. So anytime the IRS sees that type of activity, they will obviously think long and hard about the audit strategy. It's also important to note that the IRS, they have time to audit these claims. The standard statute of limitations for these claims, any claim in 2020 they have up until April 15th of 2024 to review. Any claim, either Q1 or Q2 of 2021, they have until April 15th of 2025. And then Congress even extended the statute for Q3 and Q4 claims of 2021. They have all the way until April of 2027 to review those claims. So they've given themselves quite a long runway to review. Another thing that is important to note is that the IRS, they actually have, no matter what, they have 2 years to review your claim after they make payment. And so some of these payments are delayed, right? Some may not receive their payment until 2023. And truth is, the IRS, they always have 2 years from that payment date to review. So many of you who have claimed the ERC, you may be subject to IRS reviews beyond these standard statute of limitations because of that 2-year rule. The other thing that's important, it seems like to us that the primary strategy of the IRS at this point is to try to avoid improper claims before they're paid out, right? So what they're doing, they're sending out many IDRs right now, information data requests, and they're inquiring about credits before the initial payment. So they're trying to catch these improper claims before they go out the door. And that seems to be their primary focus at this point. However, we expect that focus to shift over time. Obviously, as more and more claims go out the door, we do think you're going to see more and more traditional audits. But I do think there's probably somewhat of a sigh of relief. If you've already received your money, you're probably not going to hear from them in the immediate future. It may be 6 months to a year before you start to see the traditional audit activity. Lastly, the IRS last week did something that is somewhat unprecedented. They issued a warning shot where they issued a statement where they said, beware of abusive providers, right? I think they're starting to realize that there are many employers or many providers out there making improper claims. So in addition to the increased audit activity that we're seeing, the IRS actually came out and said, beware, if it seems too good to be true, it probably is. So they are warning taxpayers to beware of those abusive providers. And the best thing you can do to prepare yourself or to protect yourself in this environment is make sure that any ERC that you have claimed or will claim is properly documented. One of my favorite sections of the IRS ERC notice that was released, it's notice 2021-20, is at the very end of the notice, they give a laundry list of documents that you need to protect yourself, that they would expect you to have in an audit. So I'm suggesting to all my clients that they go back and they review that laundry list of items and make sure each of those items is included and saved in their audit file. So in case the IRS ever comes knocking on their door, they can easily defend themselves. They can easily explain their credit because they have all of that information prepared and saved and ready to go. John, back to you.
All right. Thanks, Michael. So our next poll question, I'm hoping to know the answer to this for the sake of all of our attendees, but have you received an IRS information data request or other IRS inquiry regarding your ERC claim? And while we wait for the answers to come in, I just want to remind people that if you do have a question about anything that we've been covering so far today, feel free to put a question into the chat area, and we will get to that very soon as we start our question and answer session.
And it's interesting to see these polls come in. 14% say yes. That's higher. I think most people expected the audit rate here to be 5%, if that. And to see that 15% now that are saying yes, it is a little surprising. And I think it goes to show that the IRS probably will push back on this more than most expected here.
Great. Thanks for all of that insight, Michael. Now, while we've been covering a lot of information today about what's changed due to the pandemic, one thing that really hasn't changed and is still kind of a staple of year-end season is the need to produce year-end tax and ACA statements. And so we've invited Janet here today to walk us through some of the mistakes that you need to avoid as you're planning for your year-end season. So I'll turn it over to you, Janet.
Thank you, John. The first one to talk about is the continual evolution of the federal ACA requirements. So for this tax year, the IRS is ready to introduce a permanent extension for the delivery of the 1095 forms to employees. Previously, the IRS would wait until the end of the year, sometime between usually Thanksgiving and Christmas, and then would announce the 30-day extension. Now, employers will have until March 2nd to provide their employees the 1095 forms. If March 2nd happens to fall on a weekend, then the deadline will be the following Monday. However, for employer reporting, those deadlines have not changed. If you have less than 250 forms and choose to do paper filing, the deadline is still February 28th. The IRS is proposing, though, to reduce the allowable amount of paper filing from 250 to 100 forms, then potentially phasing down the amount to only 10. For electronic employer reporting, there again is not an extension. The reporting deadline is March 31st. The IRS is also ending the good faith penalty relief and is focusing on penalty enforcement. IRS penalties are usually 3 years behind, so notices for 2018-2019 tax years have recently gone out. However, we have heard of companies receiving penalties for 2017 filing recently as well. During tax year 2020, the IRS offered insurance carriers and self-insured employers a special rule pertaining to certain individuals who were covered under the employer plan for at least a day in 2020. For individuals covered under an insured plan, the insurance carrier was permitted to simply make the individual's 1095 be available rather than mailing the form, provided certain requirements were met. Self-insured employers were entitled to the same accommodation for the 1095-C forms, but only for individuals who had coverage under the self-funded plan during the reporting year, but were not ACA full-time employees at any point during that year. To reiterate, this alternative method of making the 1095-C available to individuals who had coverage under a self-funded employer plan during the reporting year is not available if the individuals were ACA full-time employees at any point in the reporting year. Also note that certain states require you to provide the forms to employees, even though the federal government does not. The safest option is to provide the forms. Another call out is there are very specific defined requirements that need to be met if you are not going to furnish the 1095 forms to your employees. There's a specific list, including some examples of a physical address to request a form, a phone number for questions, and the requesting of forms as well. Also recently, the IRS released its 5-year plan. Included in that plan is increased penalties and adding technology for more efficient and expedient penalty enforcement. All of this is just the tip of the iceberg when it comes to navigating the IRS requirements. So now continuing on to the state mandated ACA reporting. These requirements are complex and constantly changing and are even more confusing oftentimes than IRS reporting. Each state has their own requirements and deadlines. How do you know who to report and what state needs reporting? How do you keep up with the changes every year? How do I know, do I report on somebody who worked in that state, or is it if they lived in that state? How do I avoid potential penalties? Here are just a few of the changes this year, as well as a brief overview for each of the states that currently require reporting. Rhode Island just announced a permanent extension for filing to mirror the permanent extension granted by the IRS. The deadline for providing forms to employees is now March 2nd, with the employer reporting deadline being moved from January 31st to March 31st. There is no account needed to file a transmission to the state of Rhode Island. California has granted an extension for employer filing again this year. The deadline to provide forms to employees is still January 31st, although California states that they will not impose a penalty for failure to provide forms to employees by this deadline. The employer deadline has been extended from March 31st to May 31st. In addition, an employer does not need to test with California this year to receive a new production transmitter code or TCC code. The codes, which usually expire on December 15th of each year, will receive a 1-year extension. The only employers that will need to test are ones that need a code that have never had a TCC code previously. With remote staff now, there are employers who have never had to report that find themselves needing state reporting. If you have more than 250 employees that reside in California that had health coverage, you have to file the forms electronically to California. If you have less than 250 individuals to report, you can print the forms and mail them to a specific address that's included in the California instructions. Moving on to the District of Columbia, DC ACA files must be a pipe delimited format. DC also only accepts current year tax forms. For corrections, DC allows both employer and employee corrections, so 1094 and 1095 corrections. In order to transmit files to DC, you have to have created an account on mytax.dc.gov. There is not a paper filing or manual option for DC, so even if you only have one employee to report, you still have to do that electronically. New Jersey requires 1095 forms to contain covered individuals. So a form with only parts 1 and part 2 completed will not be accepted by New Jersey unless they're part of a file containing forms with covered individuals. If you have less than 50 employees to report for New Jersey, you have to use the NJ 1095 form, which is a fillable PDF. As of this date, New Jersey and DC have not released their tax year 2022 requirements. So what I previously mentioned for both of those states is based on the information from tax year 2021. Massachusetts has their own specific form, the 1099-HC. Every Massachusetts resident who has health insurance needs to receive a 1099-HC form. The employer reporting deadline for Massachusetts is March 31st, the same deadline as for the IRS. The insurance carrier has to electronically report to Massachusetts all of the 1099-HCs that were issued. An employer could be subject to a penalty if an individual did not receive a form. Vermont is the last state that currently requires ACA reporting. It is a quarterly withholding form with reporting due on April 25th, July 25th, October 25th, and January 25th. There is a worksheet to help the employer determine if an assessment is due for the quarter. Everyone has eyes on the horizon to see if other states will jump on board. For tax year 2022, there were no new states with added requirements. There are some rumblings that potentially Maryland, Minnesota, Washington, and Connecticut could be planning to require some type of healthcare reporting in the future. Each state has specific requirements. Some states require you to have an account. Some states only want 1095 employee data. How do you keep up with all of this information? Make sure and align yourself with someone within your organization or an external partner that can help you remain compliant and know what the most current regulations are. Best advice number 10, don't leave your testing of year-end tax and ACA files until the last minute. Also, don't leave reviewing your data to the end of the year. During the year, try to set aside time quarterly or monthly for data review. Have reports that can pull employee data for home residence information. As you've heard throughout this presentation, there's a lot of requirements that are based on where somebody lives. With people moving and with a remote workforce now, you need to be able to track which employees reside in states that require reporting. Test early and test often to make sure your data meets the filing requirements. The sooner you start, the better off you will be.
Thanks, Janet. And we are going to serve up our last poll question for the webinar today. Of all the topics discussed today, which one causes you the most concern? Is it tax rate fluctuation, remote worker culture, ERC audit preparation, ACA compliance, or I'm comfortable with all the topics covered today?
And I think the remote worker the remote worker culture, I think that applies to so many different areas across the board, whether it's payroll, HR, et cetera, that I think that I wouldn't be surprised if that isn't the most common answer.
And I think you're right. So far, we've had 35% weigh in saying it's the remote worker culture. And that's something, as we've talked about this afternoon, that I don't see changing anytime soon. And it's going to kind of adapt and adjust as people are either hybrid or starting to come back to the office. But I think we're still going to see a lot of people working remotely, even in the new year. Other answers that are interesting, it's good to see almost a third of the people saying they're comfortable with all the topics that we covered today. And then about a fifth of the audience is still talking about ACA compliance as well. So kind of a mix of answers. But what I'd like to say before we open it for Q&A is I'd really like to thank our speakers today for Wayne, Michael, and Janet for kind of walking us through all this information. I know we covered a lot of territory in a short amount of time. We've put together this list of a call to action and hopefully some takeaways that you can take back to your organization to make sure that your year end is going to be successful. We will get a copy of this with the materials from the webinar shortly after the call. So don't feel like you've got to take this down in notes. We'll be providing this to you going forward. But now we would like to take our remaining time to answer some of your questions. If we aren't able to get to your questions during our remaining time and you'd like to reach out to any one of our speakers, we do provide their contact information. Welcome you to reach out with any specific questions, or if you've got any needs. If the discussion today brought up some topics that you'd like to get addressed, feel free to reach out to our speakers directly. But now we'd like to open up for some questions. As a reminder, if you'd like to ask a question, just use the chat panel, and those will come in for us to be able to go through. We have had a few questions come in. So the first one we're going to cover, and I think, Michael, this will be for you, is the IRS finally revealed when they're going to have the 87,000 auditors hired?
Yeah, good question. I think we're all wondering this. Truth is, I'm not sure they could hire 87,000 people over the next 10 years if they wanted. There just aren't many bodies to hire at the moment. So, I do think that the idea of hiring more IRS staffers is very much needed. They are very, very behind. I've heard that many of those resources will start out on the phones, because if anyone has called the IRS in the last 2 years, you know that it's a minimum 2-hour wait time. So I've heard that they're initially going to try to put those agents on the phone, and then they progress upwards. So I don't anticipate that influx of 87,000 people will have a meaningful impact on audit activity for probably 2 to 3 years, just because it takes time to find, to hire, to train, and then to get them off the phones.
So I'm sure we may do a webinar in the coming year around how to prepare for those audits. Another question, I think, Michael, that'll be for you, and then we'll open it up to our other panelists. If states like New York decide employees must pay in both the state in which the work is done and where it's the employee's convenience, do you expect Congress to step in to avoid double taxation?
Yeah, it's another great question. The truth is, Congress has tried. Over the past 2 decades, probably, they've been proposing a bill to standardize income tax withholding across all states. For example, they would implement a 30-day de minimis threshold in all states. They would do other things as well in hopes to simplify and harmonize these rules, because the way that the current environment or landscape is complicated. The rules change state by state. However, it has been proposed for the last 2 decades, and it has never passed. Right? It has never passed, in large part because magnet states like New York or California or Illinois, these states where people travel to work on a regular basis, they don't want to lose that potential revenue stream. So there's significant pushback. So yes, there are certain think tanks that are coming up with ideas. Congress is obviously trying, but there's more headwind there than some expected, and so the answer is yes and no. Yes, they're trying, but if history is any indicator of the future, they're going to have a hard time pushing that through.
Mm-hmm. Here's a question that I'm sure a few people have on their minds. We're struggling to automate some of the year-end close tasks on an extremely limited budget. Do you have any advice for us? And I'd open that up to any of our panelists if you've got thoughts on how to potentially look to automate some of your year-end tasks without maybe having a significant budget in order to do so. Maybe some good starting points.
I would suggest anything you can do to automate the data and the calculation of the various data for year end. That is something that takes a huge amount of time every year. So if you can find ways to automate that will save you in the long run.
Mm-hmm.
Yeah, and I'll jump in again. I think automation is expensive. We all know that. So it's hard to say how can I do automation cheaply. Truth is, I loved the suggestion earlier that Janet said, don't wait until the last minute to check your data, to verify your data. Mm-hmm. Truth is, the one thing that can take longest in the year-end process is if you have to manipulate your data or modify or change your data in any way. So going in knowing that your data is sound is probably the greatest thing you can do. And lastly, checklists. I know it's not full automation, but developing an internal checklist of what needs to be done and when is really, really, really important. There's nothing that can add to efficiency more than having a roadmap that's been tried and tested and proved over time. So anyone who's out there that has not yet developed defined checklists for your year-end process, I think that's something that can be easily done.
I think that's some great advice. This next question, Wayne, I think is coming in for you. I usually just use my prior year rates to forecast for the upcoming year. Should I be doing something different?
Yes, you should. And you should not be using those. That's a quick and dirty way of doing it, but it doesn't take into consideration all of what the state is going to look at. So for example, a lot of states will calculate their rates based on a 3-year historical period. So not only will it need to be the 2 prior fiscal years, but the most current one as well. And the only way that you would have all that information is if you have your tax rate notices. Knowing that for this upcoming year, let's just say, maybe your account balance changes drastically and you weren't really expecting that because you didn't anticipate that there were a lot of charges going to be paid out of your account. So in that instance, if you use last year's rate, you're probably going to be short in your prediction for what your tax amount should be for the upcoming quarters in the next year. So what we always recommend is actually making a forecast. There is a lot of review and searching for information, because if you think of the state factors that make up your rate, there are statutes that are out there that mandate when and how that gets done. So without knowing where to look, it's a little bit difficult. We've done that. We know the states 1 year over the next where we anticipate an increase, and so build that into your rate forecast for the upcoming year. Like I said previously, COVID has done a number on all of the states' trust fund balances. A lot have recovered, but not all. So they have to refill it, right? And the employer is who pays the unemployment tax. So that's obviously who's going to get stuck with the bill.
Okay, our next question. What's the biggest mistake you've seen companies make in trying to make their travel year-end close process more efficient, and how did they get past it? Any thoughts from our panelists on that?
Yeah, I mean, I can. It's a little bit like the automation. I mean, my answer is not going to change all that much. I mean, the biggest mistake I see clients make is lack of preparation. Right, year end's difficult. There's a lot to get done, and you want to start as early as possible to start testing files, testing data, make sure the data is clean, and make sure no deadline is missed. I mean, the truth is the biggest mistake you can make is blow a deadline, because in the tax world, blowing a deadline results in penalties, results in interests, results in headache, results in IRS complexity and resolution, and no one wants that. Anyone who's experienced it once doesn't want to experience it again. So I will say the biggest mistake people make is lack of preparation.
I think the other thing too that you mentioned, Michael, which is very important, is the documentation. A lot of times people don't keep documentation of the steps they did, when they completed things. So when an IRS penalty does come, they don't have the information they need. So I think documentation is another key thing that employers need to remember.
Got a quick question here, Michael. I think there was a question that came in around, you had mentioned a notice number that employers should be reviewing. And if you can just remind us what that number was.
And it was, as it relates to ERC, I think we talked that the notice is notice 2021-20. And that is what I would call the primary ERC guidance. There have been subsequent notices that added additional items or clarified additional items, but this one is the bulk of the guidance is found in that notice. And if you scroll down to the very end, I think it's 71, 73, one of the questions at the very end gives a laundry list of items that you need to substantiate your credit. So a list of documents, list of things you need to make sure are covered. So anyone who's concerned with ERC, with the ERC and the potential of an ERC audit should be looking very closely at that list and making sure that they have what they need to defend themselves.
Great. I know we just have a couple minutes left, so I'll just open up to our speakers. Any kind of closing thoughts, final reminders, advice that you can share? I know we've covered a lot this afternoon in a short amount of time, but any closing thoughts?
Sure, I'll take a hit at that. From my perspective, I think what you need to take into consideration is any forecasting that you might have already done. You might want to take a look at that again if you didn't take into consideration from an unemployment standpoint the issues that I brought up. I think that we've gotten in, 5 or 6 states unemployment tax rates for the upcoming year. So it's already here. And the rest of the states will be issuing those probably within from mid-November through the end of January for the most part. That's when most come in. So if you want to try to beat what's coming in the door, make sure that your estimates are a little more accurate, then suggesting that you take those into consideration.
Sounds good. I would like to thank all of you for joining us and sharing your thoughts and insights today, Wayne, Michael, and Janet. And I'd also like to thank our audience again for taking the time out to join us. As I mentioned, if you have any further questions, feel free to reach out to any of our speakers. Their email address is down below, and I will turn it back over to Eric to close us up today.
Great. Thank you, panel, for an amazing presentation. And thank you, everyone in the audience, for joining us today for this excellent webinar. Thanks again, and enjoy the rest of your day.